Hey, welcome. Today we're going to pull back the curtain on something you use every single day: bank money. We're going to explore how it's created, how it actually works, and why the entire system is built on one surprisingly simple concept: trust. Okay, think about the last time you bought a coffee. You just tapped your card and that was it, right? But what did you actually hand over? It wasn't cash. So, what exactly is that number in your bank account that just went down? Let's figure it out. The whole system, really, it all boils down to one powerful idea: trust. The reason those digits in your bank account can buy you a real cup of coffee is simply because everyone involved trusts the bank. So let's break down what that really means. All right, here's the key. Your account balance isn't some little vault of cash with your name on it. Nope, it's what's called a demand deposit. And in simple terms, it's just an IOU from the bank. It's a formal promise that they'll give you physical money whenever you ask for it. And this really highlights a key difference, right? Why is a bank's IOU accepted everywhere, while a personal IOU is pretty much only good between you and a friend? Well, it all comes down to institutional trust versus personal trust. You don't need to know the bank's CEO personally. We trust the system. It's that collective trust that turns a bank's debt into our money. So, to really see how this works in practice, we're going to follow a simple story. This little example is going to show you exactly how business activity creates bank money and makes the whole economy go around. Let's meet the players in our little economic tale. We've got two producers, producer alpha and producer beta. We've got a distributor who's kind of the middleman. And right at the center of it all, we have the bank. Our story is going to unfold in three key moments. First, money gets created. Second, that money is used to exchange actual goods. And third, the debt gets settled, which closes the loop. Okay, so here's how it kicks off. Our producers, Alpha and Beta, they sell their goods to the distributor on credit. In return, they get IOUs, also known as bills of exchange. Now, these IOUs aren't super useful on their own, but the bank trusts the distributor. So the producers take these bills to the bank, which basically buys the IOUs from them. In exchange, the bank credits their accounts with brand new, widely accepted demand deposits. And just like that, money has been created. This table lays out exactly what just happened. You can see the producers now have $2,500 in deposits as an asset. The bank holds the distributor's IOUs as its asset, balanced out by the new deposits it created, which are its liability. Meanwhile, the distributor has the goods, with the IOUs as their liability. The bank's balance sheet has expanded, and in doing so, it has literally created money. Now comes the magic of the exchange. Alpha and Beta, they want a trade. So they use those demand deposits the bank just created, each transferring $1,000 from their accounts to the distributor to buy the other's products. It's a seamless transfer of numbers on the bank's books. No physical cash ever changes hands. And here's the aftermath of that trade. The producers have the goods they wanted. And notice, producer Beta still has $500 left in their account. And the distributor? They now have $2,000 in deposits from the producers. The money did its job perfectly, allowing real goods to move between people. Finally, it's time to close the loop. The distributor takes that $2,000 in deposits he earned and goes right back to the bank. He uses that money to pay off his original debt by buying back his own IOUs. The debt is settled and the transaction cycle is complete. So, what has this whole story shown us? It demonstrated that those digital numbers, those bank liabilities created way back in step one, they fulfilled every single function we expect from money. Let's just recap that really quickly. The deposits acted as a medium of exchange, allowing our producers to trade. They were a unit of account, giving a common measure of value, and crucially, they served as a store of value. And that brings us right to this number, 500. This is what producer Beta kept in their account. It represents stored-up purchasing power, a claim on future goods and services held safely as a bank deposit. And this really captures the main idea. Banks are so vital to our economy because their IOUs, their liabilities, are so widely trusted that they become the main form of money we all use. They are the primary issuers of these powerful cash substitutes. So we've seen that this entire elegant system, from a simple card tap to global finance, it's all built on trust, which leaves us with one final essential question to think about. If it's all about trust, what happens when that trust breaks? Thanks for joining us.